Welcome to ZZ Financial, your source for the most accurate, valuable, and timely news and analysis.
Now, it's August 13th, Wednesday. So whether you're joining us bright and early on the East Coast at 8 a.m. or starting your day out west at 5 a.m., what a day it's shaping up to be in the financial world.
It really is. The headlines are just screaming about stock market records, aren't they? Especially in Japan.
Oh, absolutely. Big numbers out of Tokyo, but, as always, there's so much more going on beneath the surface, lots to explore.
Paprika, you mentioned paprika earlier. Okay, I'm intrigued. Let's unpack this.
Yes, paprika. It connects, believe it or not.
All right. We've definitely got a lot of ground to cover today. We'll be connecting dots you might not expect, like, the price of certain agricultural products to major financial moves.
That's the plan. Our mission today is really to sift through all this fresh data, pull out the most important nuggets,
And give our listeners a shortcut to being truly well-informed, understanding these complex forces shaping the economy right now.
Exactly. And we'll be exploring a central tension today, I think. Is this market euphoria sustainable? All these records.
Or is the bond market's quiet skepticism maybe a warning sign we should be paying attention to?
That's the big question. Let's dive in.
Okay, let's start our deep dive with what really seems to be the gravitational center of today's market movements.
Yeah.
The United States and its Federal Reserve.
Definitely the key driver right now.
We're seeing some incredibly strong signals pointing towards an impending rate cut, and that's sending, shockwaves globally, isn't it?
It is. It's a truly pivotal moment, I'd say.
So how significant is this latest data, the CPI data that's fueling all these expectations?
Yeah, the U.S. Consumer Price Index data for July, it just came out yesterday, and it acted as a major catalyst, really kicked things off.
Okay.
What's fascinating here, though, is the detail. The year-on-year increase, the headline number, came in at 2.7%.
Right, and the market expected 2.8%.
Exactly, so slightly below forecast. Now, the core index, the one that strips out volatile food and energy, that did rise a bit more, 3.1% compared to a 3.0% forecast.
Okay, so slightly hotter on the core.
Yes, but, and this is crucial, our sources clarify that this was primarily driven by services.
Services, okay, not goods.
Not the goods that would normally be affected by, say, tariffs.
Okay. So if the core CPI rise was mainly from services, does that kind of ease the fears that U.S. tariff policies would accelerate inflation, especially on goods?
That's precisely the interpretation.
Yeah, it sounds like that removed a key argument for the Fed to maybe delay rate cuts.
Absolutely. You hit on a critical point.
Yeah.
That services-driven inflation takes some pressure off the Fed regarding tariffs pushing up goods prices. That would have put them in a much tougher spot.
Right. And I've heard chatter about a siege on the Fed. What does that mean exactly? Sounds dramatic.
It does, doesn't it?
Yeah.
The siege basically refers to the intensifying pressure on the Fed to act, to cut rates.
For where?
Well, President Trump himself has been very vocal, reiterating calls for immediate rate cuts and, using these softer CPI results to bolster his case.
Politics playing a role.
Always. And it's not just political rhetoric. Treasury Secretary Bessent reportedly even suggested considering a more aggressive cut, maybe 0.50% in September.
Wow, 0.5%, not the usual quarter point.
Right, not just the typical 0.25% increment. So when you connect this political pressure with the latest CPI data,
it's a powerful mix.
A very powerful force pushing the Fed towards easing. And the market sees it. FedWatch, the tool that tracks probabilities.
Yeah, what's it saying now?
It now indicates over a 90% chance of a 0.25% rate cut at the upcoming September FOMC meeting.
Over 90%. Wow. So the market isn't just expecting it.
They're practically pricing it in as a certainty. It's almost a done deal in the market's eyes.
Okay, that is a strong signal. So taking that near certainty, what does this all mean for currencies, particularly the dollar and the yen? How are they reacting?
Well, it's pretty straightforward, actually. With the growing certainty of a Fed rate cut, the dollar naturally becomes less attractive.
Because interest rates would be lower.
Exactly. Lower interest rates in the U.S. typically mean lower returns on dollar-denominated assets.
Sure.
So if you can earn less by holding dollars, investors tend to look elsewhere.
Makes sense. Leading to dollar weakness.
Right. And this, in turn, is supporting the yen.
How much movement are we seeing?
The yen actually appreciated by a notable 77 sen against the dollar. By 5 p.m. Tokyo time, it was trading at 147.4951 yen per dollar.
And that's a rebound.
It marked its first rebound in 3 business days. Yeah. It even briefly strengthened to 147.71 yen earlier in the day.
Okay. And this is mostly because the interest rate gap is shrinking.
That's the main driver. the anticipated narrowing of interest rate differentials between the U.S. and Japan. As U.S. rates are expected to come down, the gap shrinks, making the yen relatively more appealing for yield or maybe just for stability.
I see. So how does this expectation of rate cuts affect funding costs, especially for, say, Japanese investors who often need dollars for their international investments, buying U.S. assets, global trade, that kind of thing? Seems fundamental.
It is fundamental, and this is where it gets really fascinating. It impacts global liquidity in a big way.
How so?
The cost for Japanese investors to procure dollars has actually dropped to a 3.5-year low.
3.5 years. Wow.
Yeah. This is reflected in something called the basis swap.
Basis swap. Can you explain that a bit?
Sure.
Huh.
Imagine it as the extra premium or maybe a discount you pay to convert funds from one currency to another for a specific time period. It's beyond just the standard exchange rate.
Okay, like an extra cost for swapping currencies.
Exactly. And our sources show this premium, specifically for a 3-month basis swap, it narrowed to the mid-0.1% range in late July.
Which is low.
It's the lowest it's been since January 2022.
Okay, so why is it getting cheaper to get dollars?
Fundamentally, it's a supply-demand story for dollars.
Yeah.
Simple economics, really.
Right.
When the Fed is expected to ease monetary policy, like cutting rates, it implies more dollars will become available in the global financial system.
Okay, so more supply.
More supply. And at the same time, we're seeing significant interest from foreign investors in Japanese government bonds, JGBs.
Ah, okay. How does that affect the dollar?
Well, when these overseas investors buy yen-denominated JGBs, they first have to sell dollars to get the yen they need,
Right.
which reduces the demand for dollars in the market. More supply, less demand, that pushes the basis swap lower, makes dollars cheaper to borrow, essentially.
Got it. Are we talking big numbers in terms of JGB buying?
Huge numbers. For instance, dollar-denominated 10-year JGBs, which are yielding a pretty compelling mid-5% right now.
Mid 5%. That is attractive.
It is, especially compared to yields elsewhere. So they're attracting significant foreign buyers looking for those higher returns. Overseas investors net purchased a whopping 3.7 trillion yen in long-term Japanese bonds just in the first half of 2025.
3.7 trillion yen.
Yep. And to put that in perspective, that's a dramatic jump from just 690.7 billion yen a year prior.
That's a massive shift in capital flows.
It really shows a powerful shift. But a note of caution here.
Okay, what are the risks?
Well, there are risks to this trend. If those dollar-denominated JGB yields were to drop below, say, short-term U.S. market rates, the incentive for foreign buyers would diminish pretty quickly.
Right, the appeal fades.
And the basis swap decline could halt or even reverse. Plus, you have to consider sovereign risk. Any serious talk of a Japan sovereign downgrade a cut in their credit rating.
That would be bad.
Very bad. It could trigger massive sell-offs in JGBs and cause basis swap spikes, completely reversing this favorable trend. So while it's good news for Japanese investors today, it's a delicate balance.
That's a really deep dive into the plumbing of international finance.
Yeah.
Fascinating. And this expectation of U.S. rate cuts is clearly reverberating through global stock markets too, right? It seems like a rising tide lifting all boats.
Absolutely. Not just in the U.S., but across continents. The positive sentiment is, undeniable right now.
We saw the records in the U.S. yesterday.
We did. The S&P 500 and the NASDAQ Composite both closed at record highs. The S&P 500 gained a full 1% to 6,445.76.
And that just boosts confidence everywhere.
Immediately. Boosted investor risk appetite worldwide, setting a very positive tone for global trading. You saw it in Europe, too.
Yeah.
Solid gains there.
Which markets?
The CCO XX 600, that broad European index, was up around 0.4%. It was led by some big bellwether stocks like tech giant SAP in Germany and the pharmaceutical company Novo Nordisk in Denmark.
Okay. And China. How did they react?
Chinese markets also performed remarkably strongly. Really stood out. The Shanghai Composite Index closed at a high we haven't seen in nearly 4 years.
Wow, 4 years.
Yeah, 3 years and 11 months, technically.
Yeah.
It reached 3683.4648, up 0.47%.
What was driving that?
Largely driven by optimism about new policy measures the government is putting in place to stimulate the economy. And crucially, those easing U.S. tariff concerns we just discussed, that helped a lot.
Right, the CPI data effect again.
Exactly. And Shenzhen's Chinext Index, the one for emerging companies and growth stocks, that surged even more dramatically, up 3.61%.
Yeah, huge jump.
And Hong Kong wasn't left out. Stocks there closed at a 3-week high. The Hang Seng Index was up 2.57%.
Any specific names moving there?
Yeah, major tech players like Tencent were surging, partly ahead of their earnings announcements, which are coming up soon.
So all these global movements, all spurred by the U.S. outlook.
They created a very bullish, very optimistic environment for Asian trading today, really paved the way for Japan's own record-breaking performance. And against this pervasive global backdrop of, well, optimism and risk-on sentiment, the Tokyo stock market just had an extraordinary day.
Tell us about it. The numbers sounded huge.
They were. The Nikkei stock average surged for the sixth consecutive day. It closed at a new record high, 43,274.67 yen. That's up 1.30% on the day.
A new record. And it broke a barrier during the day, too.
It did. To truly grasp the significance, for the first time ever, it actually surpassed the 43,000 yen mark during trading hours.
Wow.
Briefly, it was even up over 700 yen in a single day. Just incredible momentum.
Was it just the Nikkeis?
No, not to be outdone. The broader TPX index also hit a new all-time high. It closed at 3,091.91, up 0.83%.
So broad-based gains. And this is mostly driven by the U.S. rate cut hopes.
Primarily, yes. This rapid ascent in Japan is mainly fueled by those same U.S. rate cut expectations we've been discussing.
Yeah.
It just unleashed a torrent of foreign investor buying.
Foreign investors again. They're always a big factor in Japan.
They are, seeking higher returns in what looks like a strengthening global economy, or at least an economy avoiding a major slowdown thanks to the Fed.
That's truly remarkable. We often hear that foreign investors are the major driver of these rallies in Japan. But what about the local players, especially, the Japanese retail investors? Are they joining the party this time?
Good question.
Or are they still wary, maybe holding back because they fear buying at the peak? I've heard some call it height phobia.
That's a great question, actually, and it points to a potentially significant shift in market psychology over there.
Oh, how so?
Traditionally, yes, Japanese retail investors are often contrarian. They are known for that height phobia, as you put it. They tend to sell into rallies, lock in profits, wait for pullbacks, very cautious. But in this current rally, we're seeing many of them actively buying in. It seems like they're ignoring some of the usual signs of potential overheating.
Really? Like what signs?
Well, for instance, take SoftBank Group, a very high-profile stock. It hit a record high yesterday.
Okay.
And technically, it showed an upward deviation of nearly 30% from its 25-day moving average.
Which is a lot.
That's a strong technical indicator suggesting it might be overvalued or stretched in the short term. Yet, reports from a major brokerage show SoftBank still saw more buy orders than sell orders from retail investors.
Interesting. So they're chasing the momentum.
It's just exactly that. Some retail investors seem to be adopting a momentum strategy, essentially riding the wave rather than fighting it, trying to profit from the continued upward trend. Shedding that traditional caution, perhaps.
Any other evidence of this shift?
Yeah, you can also see it in the declining popularity of bearish ETFs.
The funds that bet on the market going down?
Precisely. The number of units outstanding in these ETFs has dropped by about 10% since late July.
So fewer people are betting against the market.
Clearly showing that retail investors are becoming less interested in making those bearish bets. They're embracing the rally.
Has this happened before, this kind of retail buying into a strong rally?
It actually draws some striking parallels to the 2013 bull run in Japan. You might remember the term Abenomics.
Vaguely, yes.
Yeah.
Big stimulus.
But that rally also disregarded a lot of initial warning signals about overheating, and it was fueled heavily by foreign inflows and corporate share buybacks, much like we're seeing today.
And how did that 2013 rally end up?
Well, that one saw the Nikkei rise an astonishing 50% in a single year.
50%. Wow.
So, history doesn't repeat, but it often rhymes. Some analysts also believe that renewed policy expectations from the current government, maybe a more dovish fiscal stance, are also contributing to this sustained optimism among local investors.
Making them more comfortable buying in this time.
Potentially. It's a powerful combination of factors driving this euphoria right now.
So, with all this optimism floating around, which specific stocks are leading the charge in Japan? Beyond just the big indices like the Nikkei and TOPIX, who are the big winners getting all this investor attention?
Yeah, we're seeing strong performance across quite a few different sectors, actually. It reflects broad-based investor confidence, not just narrow leadership.
Like what?
High-priced stocks,
Right.
Like fast retailing, they own Uniqlo.
Ah, okay. Big name.
Yeah. Them, along with economically sensitive machinery stocks, are doing particularly well. That usually indicates a belief in global economic recovery, or at least resilience.
Makes sense. Any tech names?
Oh, yes. Key high-tech and industrial stocks are definitely in demand. Names like Advantest,
They make semiconductor test equipment, right?
that's them. Also Fanuc, the big robotics and factory automation leader, and Sony Group, all heavily bought today. Shows continued enthusiasm for technology and manufacturing.
What about financials? They often move with the broader market.
Good point. Mitsubishi UFJ Financial Group, one of Japan's massive megabanks, actually updated its all-time high today.
First time in a while.
First time in about 5 months. So that signals strength in the financial sector, too.
Okay. Any more surprising names?
Well, maybe a bit surprising given the context, Sanrio,
Hello Kitty.
the very same. Globally known for Hello Kitty and other character goods. Their stock hit a new high today, first time in about 6 months.
Wow.
And get this, they even reached a market capitalization of 2 trillion yen.
2 trillion for a character goods company. That's impressive.
Quite a milestone. Shows the breadth of the rally. But, it's important to add a note of caution here.
Okay, what's the counterpoint?
Some analysts are definitely raising concerns about the speed of this rise. For example, Hiromasa Yamaguchi from SMBC Trust Bank.
What's his take?
He's suggesting this rapid ascent might be leading to short-term overheating. Basically, the market's gotten ahead of itself.
So what needs to happen for the rally to continue, in his view?
He argues that for further significant buying to be really justified, we'll need to see clear, visible earnings improvements from these companies. The fundamentals need to catch up to rationalize these current elevated valuations.
Right. The excitement is high, but profits need to follow.
Exactly. So while the ride is exhilarating right now, keep an eye on those upcoming earnings reports. They'll be crucial.
Okay, so while stocks are soaring and investors, even retail investors in Japan, are showing this renewed confidence, it seems the bond market is telling a slightly different story, almost a quiet counter-narrative, you could say.
That's a good way to put it, yeah.
What's happening with Japanese government bonds, the JGBs, today, and why is it diverging so much from the stock market's enthusiasm?
Indeed, there's a noticeable divergence, and it's a critical signal to watch. The yield on the newly issued 5-year JGB widened its increase in afternoon trading.
Yields went up, meaning prices went down.
Correct. It reached 1.070%, which is up 0.030% from the previous day. Not a huge move in absolute terms, but the direction and the reason are significant.
What was the reason?
It was driven by what was widely perceived in the market as a slightly weak auction result for these 5-year bonds.
A weak auction? Can you break that down for us? What makes an auction weak?
Sure. There are a couple of key metrics. First is the bid-to-cover ratio.
Okay.
That measures demand. You divide the total bids received by the amount of bonds the government offered for sale. For this auction, the ratio was 2.96 times.
Is that low?
To put it in perspective, yes. It's the lowest it's been in about 5.5 years, specifically since March 2020. So it reflects pretty tepid demand from investors.
Okay, like fewer people showed up wanting to buy.
Kind of like that, yeah. Think of it like a popular concert ticket sale. If there are way more people trying to buy tickets than available, that's strong demand. Here, the demand was relatively low compared to recent history.
Got it. What else signals weakness?
The other indicator is called the tail.
The tail.
Yeah. It measures how spread out the bids were. A smaller tail means stronger, more concentrated demand, because most bids are very close to the winning price. A wider tail signals less interest, more dispersed bidding.
So a wider tail is weaker.
Correct. And the tail in this option widened to 3 sen, which again signals a weak auction.
So what does this weak demand tell us about investor thinking?
It indicates that many market participants are wary. They're cautious. The commentary suggests many are unwilling to buy even if yields exceed 1%.
Even above 1%. That seems significant.
It is a significant psychological level.
Yeah.
And the reason? They are anticipating a potential Bank of Japan rate hike within the year.
Okay. So why are investors so cautious about buying bonds if the stock market is so bullish and optimistic? It feels counterintuitive. Stocks screaming euphoria, bonds whispering caution.
It does seem counterintuitive, but it's largely tied to expectations for the Bank of Japan's monetary policy. And it's a really fascinating interplay of forces.
The BOJ. What's the signal there?
Well, the minutes from the BOJ's July policy meeting were released recently, and they included opinions suggesting the bank's wait-and-see mode could be lifted as early as within the year.
Lifted within the year, meaning they could hike rates.
That's how the markets interpreted it.
Yep.
Pretty hawkish, suggesting the BOJ might tighten monetary policy sooner than previously thought.
And that affects 5-year bonds specifically.
Medium-term bonds, like the 5-year, are particularly sensitive to BOJ policy changes.
Yeah.
Analysts suggest their yields tend to trade historically around 40 to 50 basis points, that's 0.4 to 0.5%, above the policy rate.
Okay.
So do the math. If the BOJ were to hike its policy rate to, say, 0.75% this fall.
Then 5-year yields could easily go above 1.1%.
Exactly. So investors are essentially positioning themselves for this potential hike. They're demanding higher yields now to compensate for the risk of future interest rate increases, which makes buying bonds at current lower yields less attractive.
Okay, that explains the bond market caution, but how does it connect back to the stock market rally?
Well, think about asset allocation. As stocks surge in Japan and the U.S., bonds are typically seen as relatively safer assets, right?
Yeah, the safe haven.
When investors are feeling good about risk, feeling bullish, and see huge potential upside in equities, they tend to sell off those safer assets like bonds.
To chase the higher returns in the stock market.
Precisely.
Yeah.
That puts selling pressure on bonds, pushing yields up. But here's the interesting twist.
Yeah.
This dynamic, the stock market rally itself, might actually reduce the perceived risk of rate hikes cooling the financial markets too much.
How so?
If stocks are booming, it might make the BOJ potentially more comfortable with making a move, like a rate hike. They might feel the economy and markets can handle it.
Ah, so the stock market's optimism could inadvertently be enabling the bond market's caution by giving the BOJ more room to tighten.
It's a plausible interpretation. In essence, the stock rally might give the BOJ more leeway to tighten without crashing the equity party. It's a really complex dance between risk appetite, monetary policy expectations, and asset flows.
Okay. Beyond the big picture market movements we've been dissecting, we've got some really fascinating individual company stories today. They highlight both, surprising successes and some unexpected challenges.
Yeah, these stories really bring to life how these broader market dynamics play out on a granular level. The details are quite illustrative.
Let's dive into some of the companies really making headlines, for good or for ill. Where should we start?
Let's start with the gainers: diversification, tech demand, and consumer resurgence. Some really interesting stories here.
Okay, lead the way.
First up, Daiwa Securities Group, big brokerage firm. Their stock rose today, getting close to its year-to-date high, obviously helped by the broad Nikkei rally.
Makes sense. Anything unusual?
Yes, this is where the Paprika comes in.
Ah, finally, the Paprika connection.
Indeed. Beyond traditional finance, Daiwa is apparently aiming to become Japan's Paprika King.
Paprika King? You're serious?
Quite serious. They've acquired an agricultural corporation, securing a 20% share in Japan's paprika sales.
20%, that's significant.
It is. And get this, their plan is to turn paprika farms into financial products.
Financial products, like securitized peppers.
Something like that, it seems. Who would have thought your investment portfolio might one day include, well, bell peppers?
It's wild. Why are they doing this?
Well, it's not just about diversification, though that's part of it. It really highlights how financial firms are blurring lines, moving into fundamental resource management. It's driven by these big global trends like tightening food supply and food security concerns.
So agriculture as a strategic asset class.
Exactly. You see estimates from big players like Manulife suggesting there's maybe a $2 trillion global investment opportunity in farmland. So Daiwa's move, while maybe sounding odd, fits into that larger picture.
Fascinating. Okay, who else is gaining?
Let's talk Financ, a true industrial powerhouse. Robotics, factory automation.
Right. How did they do?
Their stock rose a solid 4.68% today to 4,629 yen.
What was the catalyst?
It came after Daiwa Securities' busy day for them, upgraded Financ's rating to outperform. They also raised the target price pretty significantly, up to 5,000 yen.
And the reasoning?
The driving force cited is a robust recovery in equipment investment, particularly in the U.S. and China.
So companies are spending on automation again?
It seems so. And that directly benefits Financ's factory automation, or FA, division, and their robotics business. They're projecting double-digit profit growth, even without help from favorable exchange rates.
So it's real underlying demand.
Looks like it. Financ is often seen as a bellwether for global manufacturing and automation trends. So this is a positive signal for the broader industrial economy.
Okay, good news there. What about the tech supply chain? Any winners there?
Absolutely. Let's look at TOK, Tokyo Okakoyo.
What do they do?
They make crucial materials for semiconductor manufacturing, especially photoresist.
Photoresist, those are key for making the chip patterns, right?
Exactly. Essential stuff. Their stock hit a new year-to-date high today, up 4.10% to 4,669 yen. SMBC Nikko also raised its target price for them to 5,400 yen.
And this is driven by chip demand.
Driven by strong demand for these materials needed to produce cutting-edge semiconductors. Yeah. Their prospects look favorable in both the front end, which is wafer fabrication, and the back end, assembly and testing, particularly with the explosive growth we're seeing in generative AI.
Another AI beneficiary.
It's another clear example of how companies providing the underlying infrastructure and materials for the AI boom are seeing significant gains. It's not just the chip designers.
Makes sense. Okay, let's shift to consumers. Any standouts there?
Oh, a huge standout today, ASICS, sportswear company.
ASICS, how did they do?
They had an incredible day. Their stock surged 17.56%.
17%, wow, an all-time high.
Yes, an all-time high of 4,150. Just phenomenal.
What caused such a huge jump?
They revised their full-year forecast for December 2025 significantly upwards. Net profit now expected to rise 36% to 87 billion.
Way above expectation.
Way above market consensus, yes. Sales were also revised up to 800 billion.
What's driving this strength?
It seems to be strong demand across several of their lines. Their performance running gear, the sports style category, and also their premium Onitsuka Tiger brand.
Where is this demand coming from?
Particularly strong in Japan, North America, and Europe. Broad-based geographical strength.
Interesting, especially since we heard competitor Nike reported declining revenue recently.
Exactly. This positive outlook for ASICS comes even as Nike struggled. It really hints at ASICS' targeted brand strength and maybe better regional execution paying off. It shows how focused strategy can lead to outperformance, even within a challenging industry.
Great example. One more gainer.
Let's highlight Toho, the famous film studio.
Ah, Godzilla's home. What's happening with them?
Their stock briefly surpassed 10,000 yen for the first time ever today. Reached 10,050 yen, finishing up 3.85%.
10,000 yen. What drove that? A blockbuster.
A massive blockbuster. It was almost entirely driven by the performance of Demon Slayer, Kimetsu no Yaiba, Infinity Castle, Arc Chapter 1, Akaza Returns.
Demon Slayer's huge. How did the movie do?
Astounding numbers. It earned 22 billion yen in just 25 days.
22 billion?
With 15.69 million viewers. Just incredible. Another hit, National Treasure, also contributed significantly.
So the box office is booming for them.
Record July box office revenue for Toho, 22.5 billion yen, smashing previous highs. Analysts now widely anticipate upward revisions to their earnings forecasts.
Wow. A fantastic example of how a single, hugely successful product, especially in entertainment, can just have a massive impact on a company's bottom line and its stock price.
Absolute disproportionate impact sometimes.
Okay, those are certainly some exciting stories of growth, innovation, and sometimes just pure blockbuster success. But as you said, for every winner, there's often a company facing headwinds. So let's turn the page now to the declines and challenges, operational hiccups and costly iterations. Who's feeling the pinch today?
Right, these stories are just as insightful for understanding market risks and challenges. Let's start with Komiyo HD.
What business are they in?
They're a major player in buying and selling secondhand luxury goods, watches, bags, that sort of thing.
Okay, how did their stock do?
It plummeted sharply today, down 9.15% to 2,780 yen, a big drop.
Ouch. What happened? Bad earnings.
Very bad earnings. They reported a massive 75% drop in their Q2 net profit, down to just 353 million yen.
75% drop. Why so severe?
It seems to be a combination of factors hitting them. First, weaker spending enthusiasm among inbound tourists.
Tourists are big customers for used luxury.
Crucial customer segment for them, yes. And that spending seems to have cooled off. Second, significantly lower profit margins.
Margins squeezed.
Yeah, their gross margin fell quite a bit, down to 21.3% from 25.6% a year ago.
Why are margins falling?
Well, the stronger yen makes Japanese goods more expensive for tourists. Plus, China's economic slowdown is likely impacting demand. This apparently forced them to shift inventory they'd accumulated in stores over to lower-margin corporate sales channels, just to clear stock.
So, tough macro environment hitting them hard.
Exactly. And while they are actively expanding overseas, they also face potential headwinds from U.S. tariff policies if they try selling goods acquired in Japan abroad. It really highlights the vulnerabilities of companies heavily reliant on inbound tourism and how complex these impacts from currency swings and trade policies can be.
Yeah, a tough spot. Who's next on the challenge list?
Let's look at Japan Micro. They make probe cards for testing semiconductors.
Okay, so tied to the chip industry, how did they fare?
Their stock plunged 14.41% today, down to 4,630 yen.
Another big drop. What was the reason here? Not demand, presumably, given the chip boom.
No, not demand. This was operational. A significant downward revision of their earnings forecast for the January-September period.
How much did they cut the forecast?
Cut it from 8.5 billion yen down to 6.8 billion yen.
Why the cut?
Directly due to equipment malfunctions at one of their factories. These malfunctions caused shipment delays for probe cards used in memory chip testing.
Production problems.
Exactly. And their full-year profit outlook also fell short of what the market was expecting.
So even in a booming sector like chips,
Operational issues can severely impact a company's outlook and its stock price. It just proves that supply chain integrity and flawless execution are absolutely paramount. You can have all the demand in the world, but if you can't make and ship the product.
right, you can't capitalize. Okay, who else?
Then we have ACSL. They're a prominent Japanese drone manufacturer.
Drones. That sounds like a growth area. What happened with them?
Well, it's a mixed story. Their stock initially rose today. There were reports about the government promoting exports of non-offensive drones to emerging countries, and ACSL's SOTN model was mentioned.
So positive policy news gave them a boost.
Initially, yes, that's a positive policy tailwind. However, selling pressure quickly emerged, and those initial gains narrowed significantly by the close.
Why the selling pressure? What's the core issue?
The core issue is pretty serious. The company now expects a substantial loss for the current fiscal year ending December 2025, around 18 billion yen.
18 billion yen loss. Weren't they expecting a profit?
Yes, it's a dramatic shift from a previously projected profit. And the reason? Special losses linked to inappropriate accounting transactions by a former CEO.
Oh, governance issues.
Serious governance issues and a significant financial hit. So this is a stark example of how positive market sentiment from policy news can be completely overshadowed by internal problems. Underscores the absolute importance of corporate oversight and ethics.
Definitely. One more challenge story.
Let's finish with Trial Holdings. They operate discount stores, supermarkets.
Okay, what's their news?
They forecast a really dramatic decrease in consolidated net profit for their next fiscal year, ending June 2026.
How dramatic.
Down 96% to just 500 million.
96% drop. That sounds catastrophic. Is the business collapsing?
Not exactly. This massive drop is almost entirely due to M&A-related costs. Specifically, 25 billion in costs associated with their recent acquisition of Seiyu.
Seiyu, the big supermarket chain, they bought them.
Yes, for approximately 380 billion. A huge deal.
So the profit drop is just acquisition accounting.
Mostly, yes. These are integration costs, amortization, things like that hitting the bottom line in the short term. Despite this steep profit drop, their sales are actually expected to surge.
Sales up. How much?
Up by 65% to 1.3225 trillion. That pushes them into the trillion yen club for the first time.
And that's all due to adding Seiyu's revenue.
Almost entirely due to the Seiyu integration, yes. Crucially, if you exclude these one-off acquisition costs, their underlying operational profit is actually expected to be robust.
Okay, so the core business is healthy, but the acquisition is expensive up front.
That's the picture. They have big plans. Opening new supercenter stores, compact trial-go supermarkets. They want to leverage Seiyu for fresh food deliveries and aim for big synergies, like consolidated procurement, buying power.
So a long-term strategic play.
Exactly. But it's a vivid illustration of how massive M&A deals can drastically impact short-term profitability due to those integration costs, even when they promise substantial long-term growth and strategic advantages. It's often a painful but necessary step for strategic expansion.
Okay, we've covered the stock market frenzy, the bond market caution, and some really specific company stories. Let's zoom out again now to some of the broader economic signals and commodity trends impacting the world. How are things like global trade policies influencing national economies or agricultural markets?
Yeah, we're seeing some truly interesting and interconnected shifts here, especially concerning global trade and agriculture. Let's start with Japan's GDP outlook and U.S. tariffs.
Okay, what's the latest forecast for Japan?
Well, the projection for Japan's real GDP growth rate for the current quarter, July-September 2025, is, well, it's expected to remain almost flat, just plus 0.01% annualized, basically no growth.
Wow, flat. That's quite a contrast to the previous quarter.
It is. The April-June quarter managed to avoid negative growth, coming in at an estimated plus 0.37%. Not great, but positive.
So why the slowdown now?
What's fascinating here is the role of U.S. tariffs, the impact of the Trump administration's policies, which many expected to hit hard earlier. Well, it now appears to be emerging later, almost like a delayed fuse burning down.
So the tariffs are finally biting.
They will likely drag down Japan's exports specifically in this July-September quarter. That seems to be the consensus building.
Which exports are most affected?
While auto exports might hold up okay, partly thanks to the yen's depreciation making them cheaper abroad,
Right.
the real hit is expected in machinery exports going to the U.S. and also semiconductor shipments going to other parts of Asia.
Why those specifically?
It's likely due to tariff-driven price hikes, making them less competitive. Also, maybe some post-rush demand adjustments after companies stocked up earlier to get ahead of tariffs.
So it shows how these trade policies can have delayed but still potent effects on national economies.
Absolutely. Influencing overall growth trajectories even months after they're implemented or announced.
Okay, let's shift to agriculture. What's happening in global agricultural markets like corn and rice?
We see different dynamics at play there. For corn, the big news came from the U.S. Department of Agriculture, the USDA.
What did they report?
They made significant revisions to their forecasts, updating U.S. corn harvest and yield projections sharply upward.
More corn expected? How did the market react?
Immediately led to softer international market prices. Benchmark Chicago corn futures actually fell to year-to-date lows, around $3.90 per bushel.
Year-to-date lows. Why such a strong reaction?
Analysts noted there was almost panic selling in the futures market. It seems these upward revisions affecting both the planted area and the expected yield per acre were quite unexpected and substantial.
Wow. Just shows how influential those USDA reports are.
It's a powerful demonstration of how seemingly technical data adjustments from a major producer like the U.S. can send significant ripples through global commodity prices and the entire agricultural supply chain.
Okay, what about rice? Specifically in Japan, you mentioned government stockpiles earlier.
Right. The story there is interesting. The effect of the Japanese government's massive release of stockpiled rice, which was intended to lower retail prices. Well, that effect seems to be waning now.
So it all worked initially, but not anymore.
It did initially bring prices down and certainly diversified consumer choices for a while, but now consumers seem to be reevaluating. Many are returning to regular branded rice.
Why? Is it just price?
Taste and consistency seem to be key factors. Consumers often perceive branded rice as having superior taste and, importantly, more consistent quality.
And the stockpile rice has issues there.
It seems so. Reports mention challenges with inconsistent quality. Also, delivery delays due to the rigorous quality checks required before release. That makes it less attractive for everyday use.
What are the price differences like?
Well, roughly, branded rice might be around $4,000 for a 5-kilogram bag. The blended stockpile rice may be around $3,000. And the lowest grade discretionary stockpile rice could be around $2,000. So, significant differences, but quality matters.
Is there anything else affecting rice prices?
Yes, a major concern now is the weather. There are rising worries over potentially poor yields for the 2025 rice crop due to the extreme heat and drought Japan has experienced.
So prices could go back up.
They could surge again, especially if distribution issues with the stockpile rice continue or if these harvest yields really disappoint later this year.
So it highlights that delicate balance in ag markets. Policy, weather, consumer taste, it all matters.
Exactly, susceptible to all those factors.
Okay, so whether it's trade policy shifts or even the weather, everything seems to impact these global markets. What about industrial commodities? Things like materials for manufacturing or energy, how are they faring?
We're seeing some signs of stabilization in some areas there. Take pulp, for example, the stuff used for paper making.
Okay, what's happening with pulp prices?
The decline in international pulp prices seems to be slowing down, maybe bottoming out.
Why is that? Demand picking up.
Partly, there's a perception that the market has bottomed out, particularly in China, which is a huge consumer, also seeing slight demand recovery globally. But crucially, supply is adjusting.
How so? Producers cutting back.
Yes. Major overseas producers, like Brazil's Suzano, which is a giant in the industry, are proactively announcing output cuts. Suzano mentioned a 3.5% reduction in production.
So they're trying to balance the market.
It's a classic supply-side response to oversupply and low prices. That, combined with maybe reduced uncertainty now that some tariff negotiations seem less volatile, is helping stabilize prices.
Okay, what about energy and metals? Crude oil and gold.
Well, crude oil futures actually fell in Japan today.
Why was that? Global demand worries.
Primarily, it seemed related to currency movements. The yen strengthened against the dollar, as we discussed,
Right.
which makes yen-denominated oil contracts appear more expensive for Japanese buyers, potentially dampening local demand. There's also underlying market volatility ahead of that U.S.-Russia summit scheduled for August 15th.
What's the relevance of that summit?
Discussions there about the Ukraine war and any hints about potential easing of sanctions could significantly impact global energy supply dynamics, so traders are cautious.
Got it. And gold.
Gold prices also continued their recent decline, similarly weighed down by unfavorable forex movements, particularly the stronger yen versus the dollar, which tends to pressure dollar-denominated gold.
Okay, so currency is a big factor there too.
Definitely illustrates how global supply adjustments, geopolitical events, and simple currency movements all interplay to affect commodity prices in a really complex, interconnected dance.
And finally, are we seeing other countries react directly to these U.S. policies? Any international policy reaction examples?
Yes, a very clear one today from Thailand.
Thailand, what did they do?
The Bank of Thailand cut its policy interest rate by 0.25%, down to 1.5%.
Why did they cut rates?
They were very explicit about the reason. The move was made specifically to alleviate burdens on Thai corporations amid significant concerns over the economic impact of U.S. tariff policies.
So they directly linked the rate cut to U.S. tariffs.
Directly. They stated U.S. trade policies were weakening their competitiveness, particularly for their crucial small and medium-sized enterprises, SMEs.
That's a concrete example.
It's a concrete and immediate example of how U.S. trade policies don't just affect, say, American or Chinese markets. They can trigger direct monetary policy responses in other nations as their central banks act defensively to protect their own economies from the potential fallout. Really underscores the global ripple effect of major trade decisions. Hashtag outro go.
Wow. What a truly comprehensive deep dive into the day's financial landscape. We've covered so much ground.
We really have.
From those record-setting stock markets, especially in Japan, to the much more subtle yet critical shifts in bond yields.
That counter-narrative.
Exactly. And those fascinating company stories ranging from, yes, Paprika, all the way to anime blockbusters. It's just so clear that global economy is constantly in motion and full of surprises.
Indeed. And we've seen so clearly how those U.S. rate cut expectations are really the dominant driving force behind much of today's market euphoria.
Right, definitely feels like the main theme.
Influencing everything from currencies to bond funding costs to stock prices across continents. Yet as we explored, beneath the surface of these record highs, there's always a more nuanced story playing out.
Always more layers.
Whether it's that quiet skepticism we noted in the bond market, almost a whisper of caution amid all the cheering or the individual triumphs and, frankly, struggles of companies navigating really complex challenges like tariffs, supply chains, or even internal governance, it truly highlights that the market is never a single, simple story.
It really does. It shows that being well-informed isn't just about knowing the big headline numbers like the Nikkei record. It's about understanding that intricate web of connections. How global macroeconomic factors like interest rates and trade policies filter all the way down to impact specific industries and even individual company performance. For you, the listener, I think the key takeaway here is really appreciating that dynamic interplay.
Yes.
And how critical it is to look beyond the headlines, to see the multiple forces at work.
Precisely.
Yeah.
So maybe as you reflect on today's record-breaking moments and also the undercurrents we've discussed, here's a thought to consider.
Okay, leave us with something to chew on.
If global stock markets are now riding so high, largely on the expectation of these preemptive rate cuts aimed at preventing economic slowdowns before they happen,
Right.
how much future growth, or maybe avoided slowdown, is already priced into these record valuations we're seeing today?
Good question. Are markets getting ahead of themselves?
And what happens if that widely anticipated soft landing for the U.S. economy turns out to be, well, a bit bumpier than expected? What does that mean for these asset prices?
That is a great question to ponder as we wrap up this deep dive. Food for thought indeed. Thank you for joining us today.
My pleasure. Lots to keep watching.
And we look forward to unpacking more fascinating insights with you, our listeners, next time, right here on ZZ Financial.